welcome to the Bourse Report. I am Marjorie Brand, Manager of Equities at Bourse, and I'll be holding officer today. Today, we'll take a look at recently released 9 months results for 2 of the companies on the local market and operate in the manufacturing sector, namely Angostura Holdings and WCO. It's been a mixed bag performance by both entities, one relatively stable performance and the other continue to face challenges. We start off with Angostura Holdings and we see earnings per share up 11%, moving from 46 cents a year ago to 51 cents at the 9-month period. Revenue growth very healthy at 8.5%, as the company has performed very well in the international segment. Revenue grew 18% year on year, as the branded rum segment has done very well, as well as there's been growth in the Angostura chilled product line. The domestic front revenue has grown 3%, as the ready-to-drink product line has done fairly well. Gross profit margin up 8.2% and profit before tax up 14.5%. When we switch to revenue performance over the last few years, we've seen steady growth by the company over the last few years. Over the last 4 years, we've seen revenue growth cumulatively around 23%, as revenue has grown from 613 million to 757 million. With the exception of last year, where revenue was down 3% year on year, we've seen steady, not phenomenal, but steady growth nevertheless at the top line. Year on year, revenue up 8.5% this year. In terms of management of expenses and profitability margins, we've seen steady performance by the company at all levels. Gross profit margin fairly steady over the last few years. In 2021, the gross profit margin was at 47.5% and currently stands 47.6%. Operating profit margin has fallen a bit from 18.2% a few years ago to the current 16.4%, as well as the profit after tax margin, but still relatively stable year on year and across the last 5 years, relatively stable. Our recommendation for the security currently stands at market weight, and our outlook at watch. Our outlook at watch has changed from stable, as there is some level of uncertainty with the impact of recently introduced excise duty on alcohol beverages. The full impact has not been fully materialized as yet and captured in results, so there is some level of uncertainty there. So our view has changed to watch. In terms of PE valuation, PE valuation is elevated compared to the sector at 17 times, but from a historical perspective, the PE valuation is fairly valued because Angostura has traded at 20 times plus PE valuation in years gone by. Dividend yield is 3%, sector average 5.6%, so a bit lower dividend when you compare to other companies in the sector. So despite the relatively stable revenue growth, we do think there are some areas of concern that would impact on the outlook for the security going forward. So our outlook currently is our watch. So in next security, we take a look at WCO. Earnings per share down significantly, 44% year on year. Revenue continues to decline, down 13.3% as the company continues to face challenges from the illicit tobacco products being introduced into the market, as well as changing consumer preferences as consumers switch to low-priced products in face of increased costs and inflation pressures. Gross profit margin down 29% and profit before tax down 45.8%. But we look at revenue over the last 4 years for the company, it's been a steady decline. Over the last 4 years, revenue has declined over 45%, moving from 610 million to 332 million. And on a yearly basis, it's been a continuous decline for the 9-month period. This year, it's down 13.3% as opposed to 18.3% last year. So a bit of a slowdown, but a decline nevertheless. In terms of management of margins, we see a different picture for WCO, where the company continues to be challenged by managing its profit margins. It's a gross profit margin moving from 75.8% down to 50.5%. Operating profit margin even further declines, moving from 62.7% down to 24.5%. So almost a 50% dip there. and as well as the profit after tax as well, a significant fall from 44.3% to 18.4%. So that's over the last 4 years, and year on year, it's also seen a steady decline. The operating profit margin moving from 32.9% to 24.5%. So revenue has declined 13%. We haven't seen a equitable decline in operating expenses. We've seen operating expenses over the 9-month period only declining by 2%. And cost of sales has also gone up by 13% over the 9-month period. So difficulties in managing the margins of the company. And this has reflected in the payments, dividends to shareholders. We've seen 2021 dividend payments come total for the year was $1.42. Last year, this declined to 67 cents. This year so far, in the first 9 months of the year, investors would have received 20 cents dividend. So last year, the last period of the year, the company would have been able to pay 32 cents. It may be a challenge for this to be replicated this year in light of recent performance. Last year, the company would have generated 27 cents in the last quarter. Again, this may be a challenge for the company to repeat in this year, as the introduction of increased excise duty may also impact the fortunes of the company, both at the top and bottom line. And that filters into our outlook change from a stable to a watch, as there remains some level of uncertainty on the full impact of excise duty on the results of the company. Our recommendation continues to be market weight, as PE valuations relatively attractive. Now, the PE valuation at 7.1 is based on trailing earnings. And as I mentioned, the company may be unable to replicate the 27 cents they were able to generate in the last quarter of last year. So this PE valuation, if the company is unsuccessful, could gravitate closer to a 10-time PE. And dividend yield is a trailing dividend yield using a 32 cents final payment for last year. Again, it may be a bit challenging to repeat that. So dividend yield is more likely will fall to closer to high single digits going forward. So based on the outlook of these valuation metrics increasing and decreasing in one instance and the other, our view remains market weight at this point in time. And what our outlook continues to be watched as revenue challenges continue to persist, and margin containment is a problem for the company as well. On a positive note, if there is any, for this year, quarterly earnings have increased steadily. In the first quarter, the company generated 6 cents, the second quarter 8 cents, and the third quarter 10 cents. So hopefully we could see some stabilization in the earnings. But again, the impact of the excise duty, it's difficult to capture at this point in time. So there could be some level of uncertainty. So that's it for us today. Thanks for joining us. If you have any questions, please give us a call or email us, or you can visit our website for further information. Do have yourself a wonderful investment.